Have you ever wondered what's truly going on behind the scenes with, well, one of the world's biggest tech giants, Meta platforms?
Yeah, I mean, we're talking Facebook, Instagram, WhatsApp. These are apps nearly 4 billion people use every single month.
Exactly. So today, our mission is to kind of cut through the noise. We're going to distill a comprehensive financial research report on Meta. We'll look at its recent performance, the bedrock of its business, the big risks it faces, its costs, leadership.
And also, maybe most interestingly, put it all under a special Warren Buffett-style valuation lens.
Right.
Look, this deep dive, it's really designed to give you the important nuggets, the key insights. We want you to understand not just what the numbers say, but why they matter, especially for a company this massive.
Mm-hmm.
But before we jump in, a crucial note for everyone listening. All our analysis is based on publicly available sources, and it's purely for educational purposes.
Definitely. This is an investment advice.
Yeah.
You absolutely should do your own due diligence before making any decisions.
Right.
And, that's why this deep dive is so important, right?
Yeah.
Understanding the report behind this helps you do that critical research yourself. Okay, so let's dive in. Meta just reported their Q2 2025 results. And wow, they're worth a closer look.
They really are a blowout quarter, you could say.
Absolutely. Their ad business just roared back. Revenue was up, 22% year over year, over $47.5 billion.
That's right. And what's striking, too, is the efficiency. Net income surged 36%. The operating margin improved to 43% from 38%. That's quite a jump.
It really is. And they generated $8.55 billion in free cash flow. Plus, they bought back nearly $10 billion worth of shares. That signals some real management confidence, doesn't it?
It certainly does. And it just underscores the incredible scale we're dealing with here. Nearly 4 billion monthly active people worldwide across their apps.
Mind-boggling scale.
And these impressive numbers, they lead us right into the heart of Meta's business model. Because despite all the talk about the metaverse, digital advertising, it's still overwhelmingly dominant. We're talking roughly 98% of all revenue.
98%. Wow.
Yeah, it's this powerful engine built on packaging user data for highly targeted ads. I mean, that's the core.
So what about the other stuff like Reality Labs?
Well, that's the other revenue. Reality Labs, their AR/VR division, it only brought in about $370 million in Q2 2025. And get this, it actually operated at a staggering $4.5 billion operating loss in that same quarter.
$4.5 billion loss.
In one quarter?
In one quarter, yeah. And then there's Meta Verified, the subscription service. Still tiny compared to the ad revenue. The real power, it comes back to that massive user base, 3.48 billion daily active people. That attracts over 10 million active advertisers.
Incredible numbers.
And here's a fascinating detail, maybe a surprising one. By 2024, Chinese e-commerce sellers, like Shein and Temu, they made up an estimated 11% of Meta's ad revenue.
11%. From just those Chinese sellers. That seems risky.
It does. It's not just a number. It really highlights a significant geopolitical vulnerability for them. Okay, so that reliance on Chinese e-commerce is definitely a risk. Those Q2 numbers, they look great on the surface, but every tech giant has its weak spots. Looking ahead, what do you see as Meta's most pressing headwinds? Beyond just, the usual market ups and downs.
That's a really crucial distinction to make because some challenges are temporary, but others could fundamentally reshape their future. So short term, you've got the digital ad market cyclicality. It's just sensitive to economic downturns. We saw that in 2022 when revenue dipped.
Right.
Then there are those U.S.-China trade tensions you just mentioned. When things flared up, Temu's spending, for example, plummeted to almost zero in 2025. That shows how one external factor can hit Meta's core ad engine hard. It could potentially cost them around $7 billion in ad revenue this year alone.
$7 billion, just from that pullback.
Potentially, yes. It's a huge chunk. We also see this AI talent war driving up costs. Meta's investing heavily in AI specialists, infrastructure, and that puts a drag on margins probably into 2025, maybe 2026. And don't forget regulatory uncertainty. In Europe, regulations around less personalized ads could potentially cut their European ad revenue by up to 16%.
16% in Europe?
Yeah.
Wow. It sounds like a lot of moving parts just in the near term. But what about the more structural, the long-term issues? Are there challenges that could permanently alter Meta's path?
Absolutely. And these are maybe even more critical to understand. The regulatory and legal challenges are a huge structural shift. Things like the Digital Markets Act, GDPR in the EU,
Yeah.
and Apple's App Tracking Transparency, ATT. That cost Meta an estimated $10 billion back in 2022.
$10 billion from one policy change by Apple.
Exactly. And these aren't going away. They're lasting headwinds, forcing Meta to fundamentally rebuild how they target ads. That's a permanent operational shift. Plus, there's ongoing antitrust scrutiny. That's always looming.
Okay, what else?
Then you have shifts in, well, consumer behavior, demographics. There's always the risk that younger generations might prefer newer platforms, right? Even though Meta's been incredibly successful at acquiring or, cloning competitors.
Like with Reels versus TikTok.
Precisely. And there's Meta's platform dependence. They rely heavily on Apple's iOS and Google's Android. Those companies can dictate privacy policies that directly impact Meta.
And then there's the elephant in the room, the metaverse bet, the one we hear so much about. How does that weigh on their future, especially with Reality Labs losing so much money?
Yeah, that's probably the boldest, most long-tail bet they're making.
Right.
Reality Labs has racked up over $60 billion in losses since 2021.
$60 billion since 2021.
Over $60 billion, with $17 billion just in 2023 alone. And the payoff. It isn't really expected until 2030 or maybe even later.
It's a huge gamble.
It's a critical structural risk. That kind of capital burn needs immense investor patience. You have to really believe the metaverse will become a profitable thing. And finally, there are the content and reputation risks. They're always there. Scandals like Cambridge Analytica, misinformation issues, mental health concerns. These carry real costs, maybe up to $5 billion a year just for content moderation, and they can definitely erode public trust over time.
That is quite a landscape of challenges and, well, strategic bets. Let's shift gears a bit. Let's unpack how Meta actually spends its money, its cost structure. You called it a mix of huge upfront investments and scaling costs. What does that look like?
Yeah, Meta's cost structure is pretty unique for its type. They have really substantial fixed costs. We're talking massive, consistent spending on data centers, servers, network infrastructure. CapEx, their capital expenditure, was over $30 billion in 2022. $27.6 billion in 2023, and expected to be over $30 billion again in 2024. Huge numbers.
Just on infrastructure.
Just on infrastructure. And a huge chunk also goes to R&D, research and development. Over $35 billion in 2022 alone. A lot of that is for the metaverse and AI.
Right.
Then you have content moderation costs, G&A, salaries for, around 76,000 employees even after the layoffs. This high fixed cost base gives them significant operating leverage. Basically, once that massive infrastructure is built, each new user or ad sale costs them very little extra.
So profits can scale really fast once they cover those fixed costs.
Exactly, which means profits can scale disproportionately.
Okay, so those are the big fixed costs. What about the variable ones, the ones that scale with activity?
Right. For variable costs, you've got things like server electricity, bandwidth, credit card fees for people buying ads, partner payouts. These grow with usage, of course. But the key thing is the marginal cost per user is incredibly low. Sales and marketing is another big one, around $14 billion back in 2022. If you look at Q2 2025, Meta spent about 57 cents for every dollar of revenue they brought in. That ratio fluctuates, but it shows their general efficiency.
57 cents on the dollar. That raises an important question, though. How do they manage these massive costs, especially when they're investing so heavily in things like AI and the metaverse? Have they shown they can be flexible?
They certainly have, and that flexibility is key. R&D and infrastructure, that's CapEx and cost of goods sold, those are by far the biggest cost buckets. It's pretty telling that back in 2022, 18% of their total costs went just to Reality Labs, that division producing almost no revenue.
18% on a non-revenue generating division.
Yeah, but Meta has shown remarkable flexibility in managing this. They ramped up spending massively in boom times, like costs grew 50% year over year in 2017 to fuel growth. But then in leaner times, like 2022 and 2023, they proved they could pull back hard. Cost growth dropped to low single digits by 2023 after those major layoffs, the year of efficiency.
Oh, yes, the year of efficiency.
Exactly. So that adaptability, being able to adjust spending based on market conditions, it's a really key part of their financial strength. It lets them protect earnings while still making those big long-term bets.
Okay, makes sense. Now, behind every giant company, there are the people steering the ship. Who are Meta's key leaders and how have they performed? Especially given Mark Zuckerberg's, let's say, unique position.
Well, obviously at the top, you have Mark Zuckerberg, founder, CEO, chairman, and he holds majority voting control. That's unique. Then there's Javier Olivan, the COO, Susan Lai, the CFO, Andrew Bosworth, who heads up Reality Labs, the CTO, Chris Cox, the chief product officer, and Jennifer Newstead, the chief legal officer. A lot of these folks have been at Meta for a very long time.
Long tenures. and their track record.
It's mixed, you could say, but generally effective. They've shown they're willing to make bold strategic shifts, from desktop to mobile, now towards the metaverse. And crucially, they did meet those year of efficiency cost targets we mentioned, cutting expense growth from 23% in 2022 down to just 7% in 2023 is pretty significant.
Well, what about the criticisms?
Yeah.
The challenges to that track record? Things like being slow on TikTok or all the issues around content, fake news, mental health.
You're right to bring those up. There have definitely been challenges. The slow response to TikTok's rise was one. The ongoing issues with fake news and mental health concerns brought to light by whistleblowers. Those are serious.
Yeah.
And sometimes, their tone has seemed overly optimistic, especially about metaverse costs back in late 2021.
And what about accountability? There's a big FTC fine, right?
Yeah.
Lawsuits.
Right. There was a shareholder lawsuit against Zuckerberg and the board over the 2012 FTC privacy agreement, which ultimately led to that huge $5 billion FTC fine. That lawsuit was recently settled, actually, in July 2025 for an undisclosed amount. And Sheryl Sandberg was also sanctioned for deleting emails related to that. There's definitely criticism about Zuckerberg's, unchecked power due to the voting structure.
Okay, so some accountability issues. But how does management align with shareholders? Is there skin in the game?
Well, Zuckerberg's alignment is pretty clear financially. His wealth is overwhelmingly tied to Meta. He owns about 13.5% of the equity, but controls around 61% of the voting rights.
61% voting rights.
Yeah, so his financial future is directly linked to Meta's stock performance. He even takes just a symbolic $1 annual salary.
That's strong personal incentive. But does that translate across the board? How about those buybacks you mentioned earlier?
The buybacks. That's where you really see management acting in a shareholder-friendly way, especially from a value perspective. When the stock absolutely plunged in 2022, the board authorized a massive $40 billion buyback program. They ended up repurchasing $27.9 billion worth of shares that year alone.
They really bought the dip.
They absolutely bought the dip, big time. And they continued, $31.5 billion in 2023, $44.8 billion in 2021. These aggressive buybacks significantly cut the share count by 8.4% in just 2 years, which boosts metrics like earnings per share.
And they started a dividend too, you said?
A small one, yes. A token dividend initiated in 2025, their first ever.
Okay, but coming back to the voting power.
Right. Zuckerberg's majority control means outside shareholder votes are, largely symbolic. Proposals for things considered good governance, like getting rid of the dual-class shares or having an independent chairman, they typically get maybe 27% support from outside shareholders, including big guys like BlackRock and Vanguard. But they always fail because Zuckerberg's super voting shares outweigh everyone else.
Right, that structure makes a huge difference. Okay, so we've covered the business, the risks, the costs, the leadership. Now for the big question for any investor.
Yeah.
What's it all truly worth? Let's put Meta under that Warren Buffett lens. How does this tech giant stack up against his famous criteria? It's interesting to see how other value investors played this stock too.
It really is. You look at someone like Seth Klarman from Baupost Group, a deep value guy. He opportunistically bought Meta in Q1 2020, added aggressively near the bottom in Q4 2022. But then he completely exited in Q1 2023, making a reported 106% gain, classic buy low, sell high.
Nice timing.
Very nice. Then you have T. Rowe Price, more of a long-term holder. They bought in 2019, trimmed a bit when it ran up, but they still hold a core position. And Dan Loeb at Third Point. He jumped in around Q3 2022 when the stock was beaten down, and then swiftly exited in early 2023 after the price basically doubled.
So a lot of savvy investors saw it as a bargain in 2022 when the PE was, around 10x?
Exactly. Around 10 times earnings. They saw the value then, and many seem to have cashed out after that huge 4 or 5x rebound.
And the key point you made earlier, Zuckerberg himself didn't sell during that dip. He authorized the buybacks instead.
Right. He, or rather the company under his direction, was buying low, just like a value investor would want to see.
Okay, so those guys saw the opportunity then. But what does a true Buffett-style intrinsic value calculation tell us about Meta's valuation today now that the stock's recovered so much?
Yeah, that's the million-dollar question, or rather the multi-billion-dollar question for Meta. If we apply a discounted cash flow, or DCF model, which is a core part of that Buffett-style analysis, we try to estimate the present value of all the future cash Meta is likely to generate. We use pretty standard assumptions, a 10% discount rate, a 2.5% long-term growth rate, and add Meta's net cash, which is about $47 billion.
Okay, standard methodology, what does this show?
Well, even with a fairly optimistic nominal case, assuming 20% free cash flow growth for the next few years, the calculated intrinsic value comes out around $530 per share.
And the current price is around $695.
Exactly. So the current price is roughly 17% above even that nominal fair value, meaning there's basically no margin of safety for a new investor today based on these numbers.
No margin of safety. That's a key Buffett concept.
It is. If you use a more conservative 10% FCF growth, the intrinsic value drops to around $405 per share, making the current price look even more expensive. You'd need a very optimistic scenario, like 30% FCF growth sustained, to get an intrinsic value, $847, that suggests the current price offers any discount.
Hmm. So the implied return isn't great either.
Right. Based on that nominal 20% growth projection, buying at today's price of around $695 implies an expected annual return of only about 6%. Buffett typically looks for at least 10%.
So the DCF conclusion is pretty clear.
Yeah, the conclusion from this kind of analysis is that Meta is just not the bargain it was back in late 2022. That significant margin of safety, it seems to have largely evaporated with the stock's run-up.
Okay, so on valuation, it doesn't look like a Buffett buy right now. But what about his other quality checks? How does Meta score on that famous checklist?
Right, because price is only part of the story for Buffett. He wants wonderful companies at fair prices. So let's run through the checklist. Valuation discipline, low PE, low PB, significant margin of safety. That's currently a fail. Meta's PE is around 31x now, PB is high at 8.4x, and as we saw, no real margin of safety. It only briefly met these metrics during big market dips.
Okay, fail on valuation. What about cash?
Cash generation, positive free cash flow. FCF revenue consistently above 5%. That's a strong pass. Meta is a cash-generating machine. FCF margins usually between 16% and 43%.
Good. Growth?
Growth and predictability, consistently rising EPS, book value per share, KGR over 10% with no declines. This one's a partial fail. Why? Well, overall growth is massive, no doubt. But EPS did drop in 2019 and 2022, and book value per share had a small dip in 2021, so not perfectly consistent.
Okay, partial fail there. Balance sheet.
Balance sheet safety, low debt to equity, high interest coverage, good current ratio. That's a resounding pass. Minimal debt, tons of cash, very strong ratios, no worries there.
Strong pass on safety. Profitability and efficiency.
Profitability and efficiency, things like high gross margin, net margin, ROE, or ROAC. Here it's kind of partial fail or borderline.
Really, I thought their margins were great.
They are. Gross margin, net margin, ROE, ROAC, ROA. They're all generally exceptional, often way above Buffett's typical thresholds. The slight issue is one metric, depreciation relative to gross profit. It recently crept above the 10% threshold, which can sometimes indicate increasing capital intensity. So mostly great, but one flag there.
Okay, so a borderline case on profitability overall by that strict definition. You've really highlighted that crucial distinction then. Meta excels on many quality fronts, but the current price seems to be the sticking point for a traditional value investor.
Right. Exactly. Meta is, without a doubt, a fantastic business. It has strong margins, it generates incredible amounts of cash, and that network effect gives it a really powerful, formidable moat. However, based on these traditional value metrics, especially the discounted cash flow analysis, it currently falls short on the critical valuation criteria. It's a wonderful company, as Buffett would say, but arguably it's not at a fair price today. The real fat pitch for value investors. That seems to have been back in late 2022 when the stock offered that clear margin of safety.
So we've seen the incredible comeback story, the really robust financials, but also those significant long-term challenges, the metaverse gamble, and how traditional value investing might view it quite differently today compared to 18 months ago.
Yeah.
What does this make you think about Meta's next chapter? Is it still mainly a growth story, maybe a value play in disguise sometimes, or something else entirely now?
It really raises an important question for anyone looking at tech giants today, doesn't it? In a world where these companies often seem to defy traditional valuation metrics, how much of a premium are you, the investor, willing to pay for a wonderful business? Especially one that's proven it can generate massive cash flows and bounce back hard from adversity.
That's the key question to ponder. Well, thank you for joining us on this deep dive into Meta platforms. We hope you feel a little more well-informed, maybe a bit more curious about the complex world of big tech. And just a reminder, as always, this deep dive is strictly for educational purposes. It doesn't constitute investment advice. Please make sure you conduct your own thorough due diligence before making any investment decisions.
Absolutely.
You can find more insights on value investing by liking and subscribing to Deep Value Investing. We're on Apple Podcasts, Spotify, and YouTube. Oh, and if you're interested in turning some of this wisdom, like Buffett's, into a daily tool, do check out the GoFundMe link in the episode description. It's for the Buffett Indicator app project. Your support could really help bring that vision to life.
Thanks for listening, everyone.